Welcome to the Pursuit of Property, where we have uncensored conversations about business, economics, and philosophy. We believe that life, liberty, and the pursuit of property are just as important today as they were in 1776. This is your host, Max Rymer. I'm one of the co-founders of the John Galt Mortgage Company, and I love discussing big ideas. All right, let's dive in. Welcome to the Pursuit of Property podcast, episode 3. I'm one of your hosts, Max Rymer.
And I'm Andrew Chermak.
And we thank you all for joining us again today. And usually we have our schedule kind of figured out, what kind of content we're going to talk about, how it's going to value add to your life, how we're going to build on what we talked about last week. And going forward, we're going to even have guests in that kind of build on each episode. But Andrew and I felt the need to talk today about something that is in the news and has been in the news, and that is this concept of a 50-year mortgage. So to set the stage, late last week, we're recording on November 11th as of right now. Late last week, Bill Pulte, who is the head of the Trump administration's FHFA, so Fannie and Freddie, came out and said that we're going to introduce the concept of a 50-year mortgage. And the funny part is I was actually at the conference where this news started to break, where Bill Pulte was actually speaking. It was pretty hilarious. He called Jerome Powell a lunatic and many other insults, and then kind of dropped two things, that 50-year mortgage concept and then Fannie and Freddie buying other private companies. So, Andrew, with that, I wanted to get your quick twitch thoughts on this concept of a 50-year mortgage. Does it work for anybody? How should we be thinking about this? And why do it now?
Well, I'll start with that. It's kind of fun that we were going to be meeting this week for a podcast episode, because just for the full history of of mortgage news, it's been about 90 years since the 1930s, like FDR era, the last time there's any major overhaul in how the mortgage industry, essentially like the amortization schedules work on it. FDR is the one that set it up, kind of like set the stage for having a 30-year fully amortized mortgage. So it's just kind of funny that all of a sudden, 90 years later, here we are talking about 50-year mortgages. But yeah, to really kind of dive into that from like the mortgage side, there's very, very few people that this would benefit on it. The reason housing is affordable, it's not because 30 years is just not enough time to spread out the payments on it. And people have to realize how the amortization schedules work. I mean, usually the first 5 to 10 years, I mean, you're mostly just paying. If you actually look at your mortgage statements, it's like 95% of it's just interest on it. And the reason for that is because like lenders know that like most people they're turning out their homes over every 7-8 years or so. So they have to kind of make their money up front on it at first. But for a 50-year mortgage, I mean, you're talking the first bare minimum 10 years is just going to be all interest payments on it, which statistically, most people don't even live in their house that long then. And really the only people this would probably be benefiting would be, again, if they're right now trying to buy a home and their debt to income ratio is 53%, so they don't qualify. And as a result, then they're like, well, if we spread out the payments an extra 20 years on it, I mean, realistically, it's probably going to bump it down to like a 48 or a 49% debt to income ratio, which truthfully, I still would recommend to a buyer, you probably shouldn't buy at that price range if your debt to income ratio is that high, because you're just one financial misstep away from a household disaster for you.
Right.
And the thing is too, because like it's whenever you like finance something out over a longer term, the interest also is going to be higher on it. So just for an example, if let's just say that a 30 year is sitting at say 6%, in all likelihood, I mean, it's probably going to, like a 50-year mortgage would probably be 60, maybe even more basis points higher on it. And so you're probably looking at around like 6.4, 6.5% interest on it. So
Where
Yeah, it's
what would you be looking at with a similar mortgage if it were a 15-year mortgage? Just to give this
Mhm.
idea, to lay it out for everyone listening, everyone watching, it's like the interest rate. This might be a very basic concept to most of you. I might be stating the obvious, but the interest rate goes up as the term length increases.
Mhm.
So if you had a 6% interest rate on a 30-year mortgage, what would that look like on a 15-year mortgage?
Probably around like 5.67 or 5.625 or so, something in that ballpark on it. Because again, the more you spread out the payments, it's higher risk for the lender on it. But like that's where it's kind of hard to see it kind of face value unless they know something I don't know about this. Is this really isn't going to benefit anyone? Again, the only people would benefit would be those that were like not qualifying because you're at like a 52 or 53% debt to income ratio, and the reality is like it's not because the reason they don't qualify for a loan, it's not because their payments are confined to too small of a time period. It's because they either A, just don't have enough household income, or they have too much debt on their books, which is really common for Americans right now, or just they're just not looking in a realistic price range for themselves.
Right. So you can see that there's not this 1+1 = 2 savings here, right? Where a 30-year mortgage is going to save you X amount of money, but then a 50-year mortgage is going to reduce your payment by that same amount or that same percentage, if you will. Because when you have a higher interest rate, even if the term is longer, you're not going to cut your payment in half. Some of the examples that I had been seeing online is if your mortgage was, $2,600 a month, a 50-year mortgage might reduce that payment when interest is all included into something like 2,100 or 2,200
Hmm.
a month. Meanwhile, to get to the heart of it, you're not actually carving into the principal. So when people philosophically buy a home that they intend to be an investment, oftentimes people get to retirement age and the only investment that they have is the equity in their home. A 50-year mortgage ultimately doesn't allow you to carve into that principal, carve into the actual thing that makes you money when you own a home. And I think that's a really important concept because it seems like the administration right now is trying to cut costs or reduce the price of the monthly payment of a home to make it more affordable, but in reality you're almost a renter with fancier paperwork. Am I getting anything wrong in that
No,
concept?
that's exactly right. And I think that's like the best, like most simplistic way to put it, where it's still being accurate is like essentially on a 50-year loan. I mean, honestly, you're basically just a renter on it, just with a lot more stipulations and a lot more paperwork on it.
Right.
I mean, really, one of the only positive sides, just because you're gonna be paying a lot of interest, is going to be like, well, at least you get that mortgage interest deduction every year when you file your taxes for for an extra 20 years.
Right.
But I mean, realistically, there's not a lot of pros to it, and it's kind of hard to believe that they actually announced that this is a program they wanted to roll out, because it's almost as if they didn't consult a single person that works in either the banking or the mortgage origination. I mean, it's like they didn't consult anyone on it.
Yeah, well, what I'm noticing about Bill Pulte, just to kind of like lay out
Mhm.
the politics as I see it, what I'm noticing about Bill Pulte and I think it's Howard Lutnick is they kind of go off the reservation. They propose these big weather balloon policies, and then it seems like they walk it back a little bit, right? So one tweet that I saw that I think Trump ended up deleting was that basically you had FDR and his face next to the 30-year mortgage, and then you had Donald Trump and his face next to the 50-year mortgage, as if it is the same emerging
Like great
story.
leap forward, right?
Yeah, yeah, it's like one small step for man, one giant leap for mankind. We've introduced this mortgage that's not going to carve into your principal at all. And it's interesting because when I was at this conference in New York City last week, hearing Bill Pulte speak, this is a guy who just goes off the cuff, I feel like. And I learned that he's only 37 years old, too. I know he comes from the Pulte family. And he also became famous on Twitter, now X, because he would like offer people $10,000 randomly if they followed him. That's how he built his artificial following there.
I wish I found out about that early on.
I think that's the reason I followed him. It was like, I'm giving away $10,000 to one random follower. But this is a guy who I think throws out wild ideas and wild rhetoric and wild policies to get a public reaction from it. And from all the news stories I'm reading today, it's that the Trump administration saw that it got roundly panned by left, right, and center all over the place. And I'm not sure it's a serious policy anymore. But one thing I did want to talk to you about, and we wanted to make sure we covered on this podcast, was the history of how we got to the 30-year mortgage and maybe the precedent it set for something like the 50-year mortgage. So you had some kind of history for us that you wanted to walk through.
Yeah, so like that's where it's kind of funny to hear that that Trump was trying to kind of like compare himself to FDR rolling out the 30-year like fully amortized loan, because that actually at the time when they wrote, I think it was, I don't remember the exact year, but it was during the Depression, like 34 or 35, something like that. And there was a huge foreclosure crisis just sweeping the nation back then. And that's because to buy a home back then was actually very difficult. I mean, typically it had to be your local bank. And so it had to be like your local bank's money. So they're only like loaning out like whatever's in their deposit, like their depository at the time. Like they can't tap the Fed Reserve for money on it. And so like a lot of banks were just straight up going under at the time, and the down payments were 50%. That was just the norm. If you didn't have a 50% down payment, take a hike. You're not buying a house. And again, these were typically like, and again, every bank had different lending rules. There was no regulation from like the federal level coming down on it. So every bank was different, but very generally, if you wanted to buy a house in like 1930, you had to have a 50% down payment. You had to have, and you'd make like the term on your loan. So we're not talking 30 years. Usually it'd be about 5 years was common. And like there's sometimes banks would do 10 years, but that was pretty rare. 5 years is pretty much the common term for that. And it was interest only payments. And then it was a balloon payment at the end where you say, oh, the whole thing is due at the end. But most people wouldn't have the money for the balloon payment at the end. So what they do is you'd roll over into a new loan. And what happened during the Depression, the reason this was there was such a just foreclosure disaster sweeping the nation is if banks did not have any money, or if your home had gone down in value and they didn't view it as a good investment, they weren't going to loan you the money. So then you just go into foreclosure then on it. So it actually was truly like a really innovative financial product that the government rolled out to have like a 30-year fully amortized loan. So you could just close on a home right then in 1935, and then you just make the same stable payment for the next 30 years, and you own it outright in 1965 then for it. And there was never really that like risk because you didn't have to just roll over into a new loan every 5, or basically you just like every 5 years you're rolling the dice hoping there's not like a major recession or anything, because if there was, you would not get the loan for you wouldn't get the new loan to pay off the old one, and you would just be screwed on it. And that's why it's kind of funny to think about Trump thinking, oh, going from the 30-year to the 50, because it really doesn't change anything. It just makes it so you just pay a lot more interest, and it takes a lot longer to pay off the loan, and you're going to have a slightly worse rate. And for like John Galt Mortgage Company, technically we'd stand to benefit from something like this, because
I was just going to say that. You have two people who own a mortgage brokerage who are telling you this might not be the best idea. Yeah,
and that's the thing is like when I first heard about that, I immediately just took out my phone, went on X, and started just scrolling, and it's really rare to have any sort of issue in the year 2025 that kind of unites the left, the middle, and the right.
Yeah.
Common theme. And this was one of those really rare issues. Like, whoa, we're unified. We're one nation on this.
I've seen some pushback online, just to give maybe the full view, if we want to call it that. I've seen some pushback from people that I like and I trust online about, well, this might not be the worst idea in the world because you are still getting people into homes. And then another caveat, I guess, is at least we're talking about what are actual policies that can bring down the cost of housing. So those two things seem to be the only, I guess, pushback to your and I's position online. But I do find it interesting because a lot of people that I like and I trust and I follow have talked about the positive impact of it. They, at least at bare minimum, you're getting someone into a home, and should they find themselves in a better financial position down the road, then they can pay more into their mortgage, or they can make overpayments, if you will. What say you to that, Andrew Chermak?
Well, I mean, that's the thing is, I mean, technically, yeah, there would be like a tiny sliver amount of the buyers that wouldn't be pre-approved before, but now they are. But we're talking just insignificant numbers. I mean, like rounding error type numbers on this, where it's true some would get in, but again, it only wouldn't. It's only going to help you out by a couple $100 a month on average on your actual monthly payment, which for a lot of people, that's not the difference between qualifying or not qualifying on it. And truthfully, even if it does kind of open up the buyer pool more, it probably is just going to start driving prices up then to kind of cancel it out on it. So really, honestly, the biggest like winners on this are probably people that already own houses, because you're just going to see your home value just kind of keep going up a little bit. But yeah, I mean, there were some people I saw that I was seeing. I mean, very, very few. They're like, oh, I think this is great because it's more options for borrowers, which technically, yes. I mean, the marketplace, it's good when there are the more options, generally speaking, the better. But I did notice a correlation with the people that were praising it are the type of people that are tend to skew very partisan, where there's not a policy with this administration that they don't agree with on it. I didn't see a lot of like, I mean, what I would kind of describe as kind of more the critical thinkers. I mean, like choosing, yeah, this is great. Where they're, I mean, again, they actually do have some disagreement with the current administration on it. So, but yeah, I mean, more options, I generally agree is better, but like it's usually when someone's like, if it's a borrower that I'm working with, usually if someone's like qualifying and they're at like a 49% debt to income ratio, usually the only scenario for that, honestly, is if they already own a house and they're like downsizing, or they're just moving up, just buying a new house. And rather than trying to do a contingency, they're just going to float both mortgages at the same time because they're going to sell the other house, which is a very temporary 49% debt to income ratio.
Right.
If it was like just a first time home buyer looking to buy a house and their DTI is genuinely sitting at 49%, I would probably advise them not to. Just because we're talking 49% debt to income ratio of their gross income before taxes, deductions, and everything. Like they are, I mean, realistically, they're like one financial misstep away from disaster on it. So it's,
you and I talk all the time when we're going through files. There's there's what you can afford and there's what you can pay for. And we have that conversation all the time about having potentially hard conversations with our borrowers, with our clients, because while the letter of the law says that you can't afford this and you might slide through the mortgage application process, there's also what is practical and what is realistic and what won't put you in financial hardship 5, 7, 10 years down the road. And as we back up towards the actual policy of a 50-year mortgage, from a political governmental standpoint, this feels like a Band-Aid solution to me. Every cost reduction measure that the government can do, any lever they can pull, means actually pain, right? It actually means pain for people, because the government is going to have to reduce its spending in order to reduce inflation. It's going to have to kind of deregulate how we build houses. It's going to have to take the red tape off of that whole process. And all along the way, those are impossible, in some cases, legislative considerations. But whenever I hear kind of an easy fix, and the way Pulte presented this was that it's an easy fix and it will help the American people. But this feels like a solution that is not actually building wealth for the average American family. And it just feels like it's that classic meme of the infomercial where the guy is slapping tape on that leaking bucket, and
flex tape.
This feels like the flex tape solution.
Yeah. No, and the thing is, like, there isn't like an easy fix for affordability. And everyone knows that. I have to assume politicians know that, even if they're not willing to admit it in this case. And the reality is, like, it really kind of feels like they're just willing to do anything but the actual solution, which
Right.
is fix our money. Just fix our money. Quit spending so much money at the federal level and running these crazy deficits where you're just destroying demand for the dollar, because all that does is just hurt Americans and in every type of purchase they're making. And in this case, we talk about housing, but yeah, the reality is they just need to fix the money supply, and stretching payments out longer is not going to help. I don't know. I didn't see the actual source of this, but I have heard some rumors that they're also floating like 15-year auto loans. Have you seen anything?
I have seen that. Yes.
Okay, yeah, I don't know. I can't speak to the validity of that, but yeah, it seems like they're just reaching at this point grasping for anything.
Dave Ramsey is rolling in his non-existent grave right now,
Oh yeah.
because the philosophy, as we spend more and more and run higher and higher deficits at the federal level, the philosophy seems to be, well, extend the payments, which is like the most unhealthy thing you can do for a family household, let alone a government worth trillions and trillions and trillions of dollars.
Yeah, it's actually funny you say that, because like I see that not just at like the government level. I mean, every company seems to be kind of like exploring that option. I mean, everyone saw the headlines earlier this year when I was like, was it like Uber Eats? You could like make a payment plan for Uber
Yeah.
Eats, or there was like a bank that was letting you
Finance your
food
Domino's
orders.
pizza.
Yeah, and like there was a few for our company. There was 2-3 months ago. I was just running payroll, and I just saw that there was a new option that had showed up that month for running payroll. It said
To finance payroll.
finance this month's payroll over the next 6 months,
Yeesh.
and I was like, "Oh man,
Yeah.
things are not looking good for your company if you're financing your weekly payroll."
It's like putting your student loans on a credit card. Yes, that is not
Exactly.
great.
So,
Not great.
but
So
yeah,
if you
so
want the opinion of the Pursuit of Property podcast cast, we are bearish on the 50-year mortgage.
I don't think it'll ever happen. I think they floated it out there. The flack they took was so extreme on it. If they're not backpedaling already, I think they will be by tomorrow. This is clearly going to go nowhere. Even if it technically gets enacted, I think we'll be seeing very few 50-year mortgages. At least I hope so.
I think our brokerage will be very reluctant, as Andrew stated before, to offer something like that.
Mm-hmm.
But appreciate you all joining us for this week's Pursuit of Property podcast. I'm Max Rymer. For my co-host, Andrew Chermak. We will see you next week.
I know. Also, I'll let you take the sign.